Okay? So, how do we record inventory when we purchase it? Well, what we're going to do is we always debit inventory, because remember from Chapter 4, that was one of our current assets. Cash, accounts receivable, prepaid items, as well as inventory. When we purchase inventory, we always debit inventory and we credit either accounts payable, because we may pay for it in the future, or we credit the cash. So looking at S5.1, we're recording $10,000 of inventory and we're buying it on account. So we're going to credit our accounts payable for $10,000, and it's for the purchase of inventory. Why would we purchase inventory and put it on account? Well, it's because the supplier of the inventory is offering us credit terms. If we purchase the inventory, they will not collect from us for 30 days. So that's an incentive for us to buy the supplier's inventory, because the supplier's offering us credit terms. That's why we credit in accounts payable. We're promising to pay the supplier in the future for goods sold to us today. That leads us to another area of discussion in this first objective: purchase discounts. A purchase discount is a deduction from the invoice price granted if the buyer, meaning us, pay early. Okay, so the terms on the invoice will say something like slide 7 shows. It might have terms that will say, number 1, 210 net 30. We will get a 2% discount if we pay within 10 days, make a payment within 10 days with the balance being due in 30. Another term you might see is N30, which means the net is due within 30 days, or EOM simply means end of the month. So there are 3 examples of credit terms that you might see which encourage purchase discounts. Okay? Moving forward, S5-2. And that would be on page 283. Okay? So, our example here, S5.1. You have shopped, and I'm seeing that this slide is mislabeled. This should be S5-1. You have shopped at the Gap store. Suppose Gap purchased T-shirts on account for $10,000. Well, we've already recorded the purchase of the inventory, debit the inventory, credit the accounts payable for $10,000. The credit terms are 210 net 30. We get a 2% discount if we pay within 10 days. Gap pays within the discount. Journalize the following transaction. We recorded the purchase, debit the inventory, credit the accounts payable for $10,000. Now we're going to record the payment. The payment on the account would be step number 1, debit the account payable for the full amount. Full amount from part 1 was $10,000. Part 2, we're going to debit the accounts payable for $10,000. Okay? Step number 2, credit the cash for 100% less the discount amount. The discount amount is 2%. So you credit cash for 100% less 2%, or 98%. 98% of what? 98% of the $10,000. So you credit the cash for 98% of the accounts payable, $9,800, and then the difference between the debit for the accounts payable and the credit for the cash is going to be a credit to the inventory. Now you're going to say, Mr. Cunningham, why is it a credit to the inventory? It's a credit to the inventory because, remember, under the cost principle, we have to record things at what they actually cost us. The inventory didn't cost us $10,000. It really cost us what? $9,800. So that's why we credit the inventory account. Okay? So that's how we handle discounts. Watch your dates. Why do I want to watch my dates? Because you want to see whether or not the purchaser qualifies for the discount or not. Next item on slide 9, purchase returns and allowances. A purchase return is where merchandise is returned by the purchaser to the supplier. A purchase allowance is a reduction in the cost of a defective merchandise received by a purchaser from a supplier. Okay, so purchase return is where the item physically gets returned to the supplier. An allowance is just a reduction for the cost of defective merchandise. Why would you give an allowance and not insist upon a return? Well, think about this. Say you order tomatoes from a supplier. If you're the supplier, do you really want a shipment of rotten tomatoes coming back to your warehouse? I don't think so. So what you do is you give the purchaser an allowance. Okay? So let's look at S5-2, Toys R Us. Okay, what's going on with Toys R Us? They buy $100,000 worth of Legos on credit terms of $315 net $45. Some of the goods are damaged in shipment, so Toys R Us returns $10,000 of the merchandise. How much must Toys R Us pay Lego if it's after the discount period or within the discount period? Let's walk through the entire example, starting on slide 10. Okay, we're going to debit our inventory for $100,000. We're going to credit our accounts payable for $100,000 because we purchased inventory on account. Okay? Next, we're going to return the faulty merchandise. We returned $10,000, so what we'll do is we'll turn around and debit the accounts payable for $10,000. We'll credit the inventory for $10,000 because we had $10,000 worth of damaged Legos. Okay? So, part A. If we pay after the discount period, what will that look like? Well, we'll debit our accounts payable in full for $90,000. We'll credit cash for $90,000 because we paid Lego after the discount period. Therefore, there was no discount taken. So when you're not using the discount, you debit the account payable in full. You credit the cash in full. What if we do take the discount? Okay, we'll still, step number 1, debit the account payable in full, $90,000. We will credit cash for 100% less the discount percent. So we'll credit cash, in this case we have a 3% discount, we'll credit cash for 97% of the account payable. So in my calculator I just punch $90,000 times 0.97 and come up with $87,300. Well, Mr. Cunningham, what's the difference going to be? The difference is going to be 90,000 less 87,300, or an adjustment via a credit to inventory of $2,700, and payment made to Lego within the discount period. Again, we're adjusting inventory for what it actually cost the buyer under the cost principle. Transportation costs. How do we handle those? Okay? If there's transportation costs and the shipping terms are free on board, FOB shipping point, the buyer pays these. So the buyer of the goods pays these transportation costs. The buyer would add those costs to their inventory. Okay? The FOB destination, free on board destination, the seller pays. So if the seller is paying, that would be recorded as a debit to a delivery expense. Okay? So, freight in is transportation costs on purchased goods. The buyer debits inventory. Freight out is the transportation cost on goods sold. We debit delivery expense. Okay? So, flipping ahead to 5-15 on slide 16. Page 287. Okay? Going right to the requirement. Record the indicated transactions in the journal of Boozer Jewelers. Explanations are not required. Okay, so they want us to record the transactions in the journal for Boozer Jewelers. Let's look at the fact pattern and see what we have to record. On April 30th, Boozer Jewelers purchased inventory of $6,000 on account from Van Dyke Diamonds, a jewelry importer. The terms were $315 net $45. The same day, Boozer paid freight charges of $300. On receiving the goods, Boozer checked the order and found $1,000 of unsuitable merchandise. Boozer returned the unsuitable merchandise to Van Dyke on May 4th. Then, on the 14th, Boozer paid Van Dyke. Okay, continuing with 5-15 on page 287. First, we have to record the transactions. The initial transaction was a purchase of $6,000 in inventory. Debit the inventory, credit the accounts payable for the purchase of inventory. Also on April 30th, they paid the freight in charges of $300. Okay? So they're going to debit the inventory for $300. They're going to credit the cash for $300. Why is it cash? Because they said they paid it. $300 in cash. Next, they're going to return $1,000 worth of unsuitable goods. How do you do that? You simply debit the payable for $1,000. You credit the inventory for $1,000. Inventory is going down. The accounts payable is going down. So we'll update our ledger accounts. Inventory now has a balance of $5,300. Accounts payable has a balance of $5,000. Okay? Got that right. Next, we record the payment. The payment is within the discount period, but we only calculate the charges, the discount, based upon what we owe for the merchandise, not the shipping charges. So we had 6,000, we returned 1,000. We're going to get a 3% discount on $5,000. So what we'll do is we'll debit the accounts payable for 5,000. We'll credit the cash for 97% of that. In my calculator, I'll put 5,000 times 0.97, come up with 4850, and the difference will be credited to the inventory for $150. So objective number one, purchase of inventory and the related issues we've covered in objective number one.